What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
Logan only ninja launches on TFTC. This is a very professional operation.
Well, you say that, he just ninja launched on you. Welcome back to Last Trade.
Thanks, Logan.
Very excited for this conversation. We're joined by Gavin Fearey from Winstead, a prestigious law firm here in the state of Texas at the cutting edge of regulatory issues and compliance pertaining to Bitcoin and the companies building in the space. This is definitely a fresh perspective on this show, diving into the regulatory side of things, which I know many Bitcoiners don't like to think about, but it's becoming increasingly important, especially considering the landscape that we find ourselves in with the SEC beginning to crack down on a bunch of crypto projects and this SEC and CFTC sort of fighting for ground in this space. But before we jump into the meat of the conversation, Gavin, why don't you just introduce yourself, what you're doing and how you found Bitcoin, and then we can talk about a lot of the really cool things you've been doing in the space for many years now.
Yeah, absolutely. Thanks so much for having me. At Winstead, I joined them in 2017. So I sort of started in investment funds. I've been a 22-year lawyer and have also done a fair amount of time working on commodity futures and work with the CFTC. And so we, looks like my dog's leaving right now. So basically, there's a bunch of hedge fund managers in Fort Worth, and back in 2017, we were helping them with their own portfolios and allocations to Bitcoin and figuring out custody. And then by 2018, 2019, we were launching funds, and some of those are registered investment advisors or Texas exempt reporting advisors, so regulated entities and subject to the custody rules. So we had to kind of figure out custody. So it was kind of fun getting on a phone way back in 2017 with like Wences Cesares at Zappo and others, and trying to figure out how we were going to get the investment funds Bitcoin or Bitcoin exposure, depending on how they did it, get it all sorted.
So Gavin, does that mean that Wences was part of your like journey to Bitcoin? You were just finding out from one of the earliest OGs that Bitcoin had value for these reasons, or did you get into Bitcoin before that point?
Yeah, I did get thrown into it. I'd been in-house for a commodities trader, so I'd sort of had to deal with all different types of futures and spot commodities and interests outside of just the regular securities industry. So that was part of my job for 6-7 years here in Texas. And literally, the week before I started, my boss said, "I got a project for you." And he said, "Bitcoin's a commodity and you've got some work to do." And I sort of, at that point fell down the rabbit hole in terms of custody and how we could possibly satisfy the custody rule. And talking with...
And could you explain the custody rule for people who aren't familiar?
Yeah, so it's a rule that sort of has an 80-year history, but it comes out of foreign investment advisors specifically, registered with SEC. And so it comes out of a sort of Bernie Madoff type situation that human weaknesses as they are, you generally need to have the assets cut somewhere else in a separate location from the person, the manager, the third party that's looking after your investment portfolio. So with a qualified custodian. And then you have to have transparency periodically into that portfolio, and maybe periodic verifications that the assets are really there. And so obviously there's no rule that gets around straight up fraud like in a Bernie Madoff situation necessarily. But there are technological things, proof of reserves, for instance, that can help prove the assets are there. So the rule's been in place for many, many years. In fact, there's a new proposal to try and switch it up now.
Yeah, and it's very interesting with Bitcoin specifically because just of the nature of the protocol and the primitives that exist on the protocol that allow you to custody Bitcoin in a very unique way when compared to incumbent financial assets, whether it be stocks, bonds, commodity futures, whatever it may be. And I think that's one of the most interesting things of this particular point in time in the context of regulators trying to understand Bitcoin and Bitcoiners trying to explain how this thing works to regulators, is that we have a brand new way to custody a bearer asset in the digital age with Bitcoin and the way the private public signatures work. And I think that's one of the biggest frictions between the Bitcoin industry and regulators right now, is that we're here screaming like, hey, there's a better way to do custody natively on the protocol, and you want us to do it in this sort of archaic fashion as laid out by the rules that were set 80 years ago. And so in your experience, I know you wrote a paper with Caitlin Long and Brian Bishop literally 5 years ago yesterday that you sent to the SEC trying to explain this. So what has your experience been like from your perspective trying to get regulators to understand like, hey, there's a new way to do custody with this asset?
But Gavin, before jumping in, I actually wanted to just take one step back on the custody rule, because I think it's important, and at least from my personal understanding, the custody rule doesn't apply to spot Bitcoin. It applies to securities. And if you can correct me if I'm wrong, but if that is true, is it partial the confusion the past 5+ years more related to who wants oversight, as we'll talk about in this conversation, whether it's the CFTC or SEC, or is it more from a just pure understanding, because what we're talking about is a commodity, but it's digital in nature, so it resembles a security in the sense that it can evaporate overnight, or like it can like just be taken, and then that's where the RA custody rule comes into play, and this like not fully understanding that this is a digital asset, but it's a bearer asset that's similar to a commodity. If you can touch on that before, because I think that sets the framework for like what the letter was set. Yeah,
we had conversations with FinHub when it was produced, the Valerie Schertz-Panic Division of Investment Management, about how our clients would satisfy the custody rule, and there were sort of three big problems that needed to be sorted out. One was, is Bitcoin funds and securities? Because the old rule applies to funds. So kind of the question is, can you spend it? Sounds a lot like funds. But traditionally, commodities have not been fallen into that group. So is it funds and securities? That's one problem with that rule. And then another problem is, who's a qualified custodian? Is a trust company enough under the definitions there? So that was another sort of long-standing question, and there were questions about bankruptcy remoteness even back then. And so funds and securities, qualified custodian. The other thing, it has an exception that kind of gets exposed by some of the early Bitcoin trading. So let's say you take your Bitcoin out of cold storage and you put it in someone's hot wallet, and you transfer it to an exchange or a trading platform to get the trade done. The digital asset world, sort of, at least as things were done, exposes the fact that it leaves the custodian's hands when it goes out of the cold wallet onto some hot wallet for the exchange in order for the trade to happen. So there's a sort of authorized trading exception in the custody rule that says, okay, we can kind of leave the it used to allow assets to leave that, but that exposes the fact that during that period, there's no protection, there's no custodial protection for the asset. You're exposed to whatever exchange and whatever commingling is happening there. So those are kind of the issues we were dealing with.
that last part is so interesting because it kind of shines a light on how with traditional assets that just wasn't an issue of like the asset leaving the custodian and then being on a trading platform. I suppose that's probably handled with like it some accounting thing of it's being lent out from the custodian and it's still technically sitting at the custodian when it's being traded. But in digital assets, there's like a greater level of transparency and actual physicality in the sense of like where this asset is sitting at any point in time. It's clearer, and that in a way makes digital assets like a superior instrument in terms of accounting and trackability and all that, in terms of the clarity of what's happening at any moment in time than we have had with the traditional asset world.
Yeah, I guess another way to say that is, and correct me if I'm wrong here, Gavin, but the protocol is the clearinghouse at the end of the day.
Yeah. No, that's fair. That might rub up against some of the traditional securities kind of establishment or rules, but absolutely. That's right.
And so now maybe, Gavin, it would be great to hear the story of how, you're starting to work with digital assets in your capacity as a lawyer. Your boss puts this on your plate, and then fast forward a little bit, you're in a room with Tour de Meester, Caitlin Long, some other folks, trying to hammer out what you've learned, about like, this is how it should be done, and the regulators should be aware of this, and how there's a better way. So how did that come about, and what was that, what was that experience like writing that letter?
Yeah, so this 2018, we sort of put together a group. I had been sponsoring with Winstead a sort of smart custody workshop that was on at Blockstream that Brian Bishop had been put together with Christopher Allen, who's a cryptographer that helped co-author the TLS security standard. So for a lot of payments right now still on the internet, he helped co-author that standard. So he was looking into adversaries for smart custody Bitcoin. And so we were sponsoring that, and sort of at that event, out of that event came getting to know Brian Bishop a little bit, as well as Caitlin Long and Angus Champion de Crespi at Ian. He was then at EY. So that all and Tour de Meester, of course, was also sort of part of the discussion. So we were working with Tour on a fund at the time. So all of that came together with, okay, the SEC is, considering ETFs. This was 2018. Hard to believe that it's still the case right now. What do they need to be thinking about? Because if they start treating, Bitcoin in sort of fungible bulk, or they allow a rehypothecation from the ETF, or there's no way to receive the actual Bitcoin from the fund, for instance, that would be nice. We even mentioned that. And just understanding that there is no lender of last resort in this case. So this was before, the meltdowns happened in other digital assets, but in terms of, margin lending, rehypothecation, there could be a lot of undetected exposure if these assets are being rehypothecated, and Bitcoin natively doesn't really, you need to have reserves to be able to meet your commitments, because there's no way to print it.
Yeah, it's incredible. I'm looking at an excerpt. One of the key points in bold is we believe that digital assets are a unique asset class with unique strengths and abilities. And then followed by that is, as a result of division of labor, any economy will over time develop services that assist savers in keeping their assets secure. The institution of third-party custody itself is about as old as civilization, with earliest records dating back to 3300 BC. That was just so prescient, reading that, especially being close to, a day away from 5 years and still having these discussions, and also just debating on custody and having intermediaries facilitate and trusted third parties. given that if Bitcoin is to succeed, we're going to have trusted parties across the spectrum and how an economy ends up, being created and delivering value across it.
Yeah, absolutely. And obviously a lot of the providers at that time were coming at it from a sort of omnibus account point of view. And that from their point of view, they're used to omnibus accounts, and it facilitates, sort of intraday off-chain settlement and some other things like that, we had a big debate back in 2018. There's circumstances in which if you properly disclose it, or in which you can and should be having omnibus accounts, even though Bitcoin is natively segregated. And so we were sort of just having to kind of battle with that, and we had some pretty good disagreements about it.
Yeah, I think the other one that's most, I don't know if relevant, but really hit home was, you guys called out multi-sig, and basically one other key bullet point was we should leverage the technology of this asset class to protect investors in ways not previously possible. I thought that was another really kind of key point that was recognized so early on. And we're even seeing this today with the ETFs. They kind of hit on the opposite of what you guys described as the right way to create a product for the market. And it's similar to Jesse's piece and calling out, you mentioned some of the uncovered calls, but then also just the central points of failure that exist with a single counterparty that we've seen the past, close to 15 years now in this industry.
Yeah, one of the big things I've been surprised about, and this was sort of the risks that we warned about, is people sort of assumed that because it was Bitcoin, you could just, or other digital assets, you could just have a books and records that segregates at the books and records level. And then you can keep the actual assets or the keys in different addresses, and you can have multiple addresses that suit what you need, but those don't match even necessarily what's a platform asset versus what's a customer asset. And it's pretty amazing to me that sort of was the modus operandi for many of the exchanges. Was we'll do everything we need on books and records, and then you have a complete disassociation with the actual wallet structure of where it's actually being kept, and that sort of was extremely, it led to a lot of the dangers with wallets being mislabeled, and even with auditors coming in and looking at, say, what was in FTX, not knowing what wallet belonged to what asset, etc. But that mindset that you don't segregate by wallet address was kind of crazy to me.
Yeah, it strikes me as a bit of a lag still that we're still living through with the digital asset industry as a whole. Of people are coming in and applying what has worked in the traditional world in terms of all operational aspects, custody, accounting, being part of that. And, as a result of that, like, people are designing their systems, their custody, and how they're accounting for individual client balances, not in line with what's possible with wallets and digital addresses. And, it's sort of too bad that, like, you guys put out this advice in 2018, and I don't think the regulators are there yet still, 5 years later, in terms of understanding that, that example of how digital assets allows a greater level of clarity and transparency real time about where the assets actually sit, and how that became a problem with the clearinghouses example. That plays out with custody too. We have a greater level of fidelity and granularity with accounting and reporting that's possible here, and people still haven't adopted that as to build these systems in a Bitcoin native fashion.
Yeah, I mean that's what's been so exciting and fascinating. Like, Gavin, reading that and looking at it, and Jesse, Marty, and myself, we talk a lot about custody and the maturation of this market, and we've been looking at this problem for a very long time. And whether it's providing services, building tools, and so it over time, I think it's a function of like proof of work in being in the market and recognizing whether it's FTX or seeing products and services that are delivering what the protocol wants and that makes sense from a long-term sustainability of like securing the asset or building a foundational business. And so it also makes sense if somebody comes into the industry from traditional finance or coming in from Wall Street and they have a mental model of the world that's different. But what's really fascinating, I'd be curious, is like how are you able to come to that conclusion so quickly? Because you mentioned coming in 17, this was put on your plate, so you're looking at it. You have to be, I guess, somewhat curious, or maybe not curious, but it was your job, so you were forced to do it. But then, like, to put that together within, let's call it 3 to 9 months, I would imagine was the time frame that it was so obvious that this was the way it needed to be done. Like, can you share kind of some of the, like, to the extent you can, I know it was 5 years ago, but what was going through, or was it really the support of the team that helped you kind of see that vision?
Yeah. Yeah. So when you are, when you're lawyering, and you're launching a fund, you start with a set of documents that you've used before, and then you tailor them for the asset. And the risk factors that no one reads are, you spend a lot of time on those risk factors, hopefully, because you see products, especially in other digital assets, have gone full cycle, DeFi funds, et cetera, definitely gone full cycle. And those risk factors become kind of important at that stage. So a lot of it was, there wasn't a place to go on the internet to pick up really good disclosures about Bitcoin and about the Bitcoin network. So in a legal way, it wasn't like Coinbase had public filings at that point. So we, or anyone else. So we really I basically locked myself for 3 weeks and wrote a bunch of risk factors for a Bitcoin fund that we were working on. And part of that, I think, was I needed to understand, how the properties of the asset were just fundamentally different, and what that meant, what sort of risks does that create? A lot of the failures we've seen in other markets with the FTXs and Celsius, et cetera, like, those customer agreements sometimes were complete roadmaps to the fact that they were going to take the assets and use them somewhere else. So my journey really was, okay, I need to get involved in understanding the adversary's self-custody. When is it appropriate to have custodians? How is this not centralizing the risk by having a qualified custodian, creating a honeypot? So we were just trying to figure out all of those issues.
Yeah, you brought up the concept of qualified custodian, and I think that's been the big topic in the news the last 6 months with the bankruptcy of Prime Trust and the subsequent purchase of Fortress Trust by Ripple. And so you had Prime Trust was a qualified custodian leveraging the Nevada charter, I believe. And then Scott Purcell, same person, started Prime Trust, went and started Fortress Trust. And in these two instances that they were qualified custodians, they checked the box. However, it has become abundantly clear that they actually didn't know how to secure these assets properly, and it led to a loss of funds for their customers in both cases. Luckily for Fortress, Ripple stepped in and bailed them out. And actually, I don't even know if that's completely across the line yet. So I think that's yet to be determined. But I think it gets to the point of, again, this sort of intersection of the incumbent regulatory structure and this new asset, and something that Bitcoiners and people that are looking to get into space need to be aware of is, yes, you may have certain entities out there that check the qualified custodian box, but if you actually do the due diligence and look into how they're custodying the asset, in many cases, they're not doing it correctly. So it's really, there's a lot of landmines that exist out there, people sort of having undeserved levels of confidence in their custodian with this new asset. And I guess the question being is, like, how do we ensure that somebody who's checking the qualified custodian box is actually securing and custodying the asset properly?
Yeah, that's right. And because it was all new, a lot of the agreements and the systems that everyone was using were completely all over the board. So you had sort of massive people, obviously with a lot of FOMO and wanting to just sign any contract that came their way to get the yields that they could get. And, it all played out over not really that many years as to, some of the leverage, some of the sub-custodians, some of those risks. So again, I'm not sure it got a ton of airspace, but we wrote to the SEC as part of a legal working group I'm part of, because Wall Street Blockchain Alliance, and it's a mix of lawyers that's been talking to each other every 2 weeks for probably the same amount of time, at least 4 years for me. And we sort of wrote a list of things for the new SEC custody rule, the proposed one. This, they asked, what are some of the things we should be looking at for qualified custodians? So we sort of did a little bit of a list, and I think the problem is just that everyone's doing things in different ways, and it's kind of hard for the SEC, as being the one that is regulating investment advisors. There's a lot of custodians, traditional custodians, that are really upset with the new proposed rule. I think 29 organizations like the FI, Futures Industry Association, and ISDA, and all these large trade associations wrote to the SEC about the rule and said, look, you are, in trying to extend this rule for things like digital assets to try and change some of these concepts, you're completely messing up traditional custodianship of other assets. And so that's still playing out. And you can see, custodians like, why is the SEC regulating me? I'm not the investment advisor. And so there's that friction is still there, is who is regulating the custodians.
Yeah, actually, Logan, can you zoom us out? Because I think this is a really important conversation. There's three key components, if we can kind of dig into. There's QC, and is it even qualified custodian? Is it even required for an IRA or individuals? Because we're talking about spot BTC. If it's a investment fund trading derivatives, it's a different story, but just spot Bitcoin. And then the second part is what, to Marty's point, is I think the qualified custody has confused a lot of individuals, because they hear that term and they think of somebody like a prime trust is a qualified custodian, but they have the state charter in the recognition of the bankruptcy remote, the legal wrapper, but then they outsource a sub custody to an inferior solution, versus somebody like a BitGo, who has a South Dakota trust charter but also has their internal world-class custody, similar to like a Gemini, right? Gemini has a New York state charter coupled with and it's similar to, I believe, Coinbase. And so they're very different. And so people, I think, get confused on that. And then the last point is that new custody rule. And I think that's been a conversation. And I initially was very concerned or skeptical of it as well. But then I became a lot less, and you can tell me if this is incorrect, after realizing that this falls under all assets. It's like alternative assets, real assets, real estate, alternative investments. And this is it seems like a very gross overreach from the SEC from a federal level onto state level. And there would be so many people up in arms. It's much larger than digital assets that I can't imagine it ever gets actually enforced. So I know there's a lot, but maybe working down, if we can talk through, is QC actually required for spot BTC? And then some of the confusion between QC and custody. And then maybe we can dive into the enforcement, and is it actually realistic? Because I think that's on a lot of people's minds, or they hear about it and they don't really have that dispelled into those different cohorts.
Yeah, for sure. So let's start with what's a security and what's not a security. So there's kind of two different things going on. One is does this fall under the CFTC's jurisdiction? Is it a security, so it falls under the SEC's jurisdiction, right? So there's that top level discussion, or is it some other type of asset? And then, because frankly, investment advisors, right, they invest in real estate, they invest in artwork, they invest in all kinds of real assets that are not secured like securities at all. And so when it comes down to this custody rule, what they've tried to say is it used to apply just to fund, and it still does because the new rule hasn't come into effect. So this is just for registered investment advisors and any state investment advisors that are subject to the custody rule. And some exempt entities are, like in Texas, some hedge funds or managers are subject to it. It used to be, and it still is, funds and securities. Does Bitcoin spend? So you can totally disagree about that. Bitcoin spends its funds if you don't keep it that simple. But traditionally, commodities were not viewed as subject to the rule. So what you have now is a new rule. One of the proposed rules is let's extend this to all client assets. And what's kind of funny is that people didn't notice, but in Dodd-Frank, there was a new provision of the Investment Advisors Act, that statute that never has been used until now, that says safekeeping obligations of investment advisor apply to all client assets, not just funds and securities. That was part of Dodd-Frank 12, 13 years ago, right? So now it's finally being kind of used. And as I mentioned, these 29 trade associations have just written on September 12th of this year to the Division of Investment Management saying, we don't like your rule because your proposed rule, because first of all, you're extending it to things like loans and real estate, artwork, precious metals, physical commodities. And you're trying to, is the tail wagging the dog? You're trying to redo how our traditional custodian models work in those areas. And the irony of this is partly that digital assets are the reason that one of the reasons the SEC's been trying to grapple with the native properties of digital assets and how you bring it into the rule. So,
and if you take it one step further, like we didn't even bring up the fact that they're trying to not recognize the state charters as part of this, right? Is like the South Dakota, and do they fall under the qualified custody or stripping them of that kind of like credential?
Right. So, I mean, you can imagine this rule kind of upsets all of these different businesses that work in certain ways. Like the rule says, for instance, the proposed rule says that you must have possession, that the qualified custodian must have possession and control, right? So the way they said, kind of for digital assets, they said, okay, we think that possession and control is the qualified custodian must participate in the change of beneficial ownership. So if you take private keys, right? One of the requirements is one of those private keys, or two, depending on how you read the rule, one key the qualified custodian must sign a transaction to participate in that change of beneficial ownership. So that creates a bunch of problems, even in digital assets, right? If there's some model where the asset goes to a hot wallet that the custodian doesn't control. So that rule is upsetting all these other people where there are other types of assets, precious metals, real estate, where is the qualified custodian participating in the change of beneficial ownership? What does that mean? Why are you making us rethink everything? So I don't think the answer is as close as people would like. 29 trade associations asked the rule to be withdrawn, and they basically said, please take a look at how custody actually works before you come up with a new rule. That's basically what the letter says. And so it's ironic that digital assets are actually forcing, well, maybe the qualified custodian should, in theory, participate in the change in beneficial ownership. Maybe they should, right? And so, I don't think we've seen the longer I'm in the space from writing that letter, the more you realize that this is a huge time frame of change, so.
Well, and then that begs I was going to say that begs the question, we've been talking about this in the context of asset allocators trying to bucket Bitcoin into a particular sleeve of their portfolio allocation. Is there something similar on the regulatory side where you just need to separate this from all other assets and treat it completely differently?
Yeah, I think it does beg the question of what the Division of Investment Management will do next. They have the regulatory authority under Doug Frank, in my personal opinion, but do they have to rethink and say, well, what's custody? What works for custody in one asset isn't what works necessarily in another asset. So trying to find a unified rule is trying to make 20 different realities fit a rule. It's kind of hard to write that rule.
Sounds like an impossible task.
Yeah. It sounds like the dreamed up solution of a centralized planner trying to come up with a unified theory of everything custody for all assets. It's impossible.
Well, they did put a lot of time into it, and our conversations with them started six years ago. And now we're just at the proposed rule stage getting criticized by various traditional custodians. Yeah. So, and I think it does. To answer your question, Jesse, I think it means that rules have to take into account the asset that they're trying to ensure is properly
reasonable. And I wanted to tease out how it sort of feels like part of what Michael's number 2 point there, and what you were talking about, Gavin, is that qualified custodians don't necessarily have the competencies, the core skills and competencies for executing digital asset transactions, and many of them that have like dipped a toe into the space, they are trying to bolt on those competencies to how they've done things for their whole careers, right? Like the Scott Purcell example at Prime Trust, this was just the growth area for a custody business. So they, decided to say that they were open for business to be a digital asset qualified custodian. And without really having developed those skills of like, what does it take to be a responsible, skilled, knowledgeable platform for that, and what are the risks inherent in all the surface area of attacks that you have to make sure you're accounting for. And so like it didn't work for Prime Trust, and it didn't work for Fortress because they had this sort of bolt-on approach to digital asset custody, as opposed to someone like BitGo, who has grown up in a Bitcoin native participant in digital asset custody, and has the chops to set up systems the right way.
Yeah. It's a real, I was gonna say it is a big gap in the space from, we had Matt McClintock on, I don't know, Gavin, if you're familiar, from Bespoke, and he, I consider you like top of like your class and what your background coupled with digital assets, and similar with him in trust planning. But even at his level, when it comes to trust planning, you have to get the assets out of the estate and going into a qualified custodian. And right now that means giving it up to a third party. And that's the best that we have. Well, what happens if that third party goes out? He referenced, I believe, Anchorage, and I know even BitGo being world-class. Like, what happens in 10 years when you need to pass those assets on at the exchange? The history of the past 10 years hasn't been good for exchanges. So it's a real problem. And just like, how do you actually plan long-term for the transition of these assets into your estate?
Yeah. And I would just add like one little thing. I think that's just driving a lot of frustration within the Bitcoin industry of people who grew up in this space and understand the primitives of the protocol intuitively much better than any qualified custodian does. And in the case of Prime Trust, like they made the biggest Bush League mistake that you could, which is they threw away the private keys that they previously had ownership over and were allowing customers to send funds to wallets that they destroyed the keys to, which is allegedly. But let's pretend like that actually happened. If that did actually happen, like again, that's like a Bush League mistake that any individual Bitcoiner knows. Like don't do that. Right. The fact that a qualified custodian made that mistake is mind-boggling.
Yeah, and in that 2018 letter, we actually, and this was someone else's point, but they actually said, look, you actually need to hire qualified engineers if you're to assess like the safety of a Bitcoin, and I know it's about disclosure and they're not necessarily, then here's the problem, right? The problem is that the current law regulates investment advisors, and there's these rules about qualified custodians and them using them. There's not really in the United States, other than these trust companies, and a very, one or two federally chartered before that got put on hold. Just there's not really a comprehensive regime, if you like, for regulating custodians. And I know that I can't tell you when federal regulation will come, but that actually is part of some of the proposed federal regulation, that certain custodians would be regulated, and by a federal entity. So whether that's the right or wrong, that's part of the problem. And to Jess's point, like, that you can see it from a regulator's point of view, right? They're like, okay, I know what a trust company is. You go hire a technology company that's totally separate. We'll kind of regulate you because we know what you are. And then we'll make sure your contract looks kind of good with the technology company. And that way we don't really have to figure out the technology piece, right? So you can see why under the current law, that's the way they prefer things to go.
Yeah, but from a pure, like, just pragmatic, logical, game theoretical perspective, it absolutely is insane, just like what we know. But then also, like, BlackRock is the premier example of this. Like, if it's all successful, that means Coinbase holds billions and billions, potentially trillions of dollars. That doesn't end up good for anybody. And we've seen this with, like, BlockFi was a great example of those mismatches on, like, the liabilities versus, and they were outsourcing, they sent it off to Gemini. But these, like, custodial agreements, like, there's one thing to build it in-house and have the competency, and that's already, like, very scary, because if you have any breach, any kind of individual inside that ends up going rogue, and ideally you have the permissions and the ceremonies in place to prevent that, but you still have that over your head, and then you extend it by giving up all of that, like what you referenced, to a contract to a third party. Now you're hoping to God that nothing happens with them, but they're also holding everybody else's assets, and they're generally commingled. It's just not a sustainable, pragmatic way to think about how this industry will, like, grow if it is to become, $1 trillion and $10 trillion. There has to be a better way.
And to you guys on the technology front, like, one of the questions the risk factor I had to write back in 2018 was the risk of short squeezes in the market. Like, this is a question to you, like, what happens when $1 trillion needs to find Bitcoin and needs the actual asset? Imagine what the liquidity issues that could play out worldwide. I don't know, that to me, not being, I'm just a lawyer, but that seems like it's a big concern.
It actually is. We just talked about this as far as redundancies, right? Building this space, you want redundancies across bank accounts, liquidity providers, and making sure that you can always source the Bitcoin as the market takes off. You want to be able to never look at a client and say, oh yeah, you want your exposure, and that you're going to have to wait, or you have to find Bitcoin. And that will happen. Everybody always talks about this. It's like the mother of all short squeezes when everybody's trying to get through the door and it's like this big.
Yeah. And Gavin, you're kind of projecting forward what we've seen over the last couple of years, 3 years, has been a decline of balances on exchanges. And how far does that go? Does that just keep chugging along for another 6 years, and then there's basically no Bitcoin on exchanges, and then somebody gets caught in a massive short position and they have to cover? And suddenly the price is gapping up because there's no willing sellers. And, the price of Bitcoin might at that point be 100,000, and they can't find anybody to fill that amount of Bitcoin necessary until, 200,000. Those are the forces that collide here when you have a finite supply asset that nobody can print more of. And yet people will continue to speculate against it.
Marty is so ready for that in his bones. This is a little inside. Every couple of weeks, I get a 8 o'clock at night a text. It's like, I'm so bullish right now. And one day, it's going to turn out the price just like rips. And he's like, I told you, I felt it.
Again, this points back to the beauty of the supply schedule. Many people neg it, but it was important that Satoshi set it up the way he did so that the supply could proliferate and you could incentivize people to plug in miners and acquire Bitcoin. But I'm looking at the supply right now. There's 19,490,993 Bitcoin on the market. So we have less than 1.6 million Bitcoin left to be dispersed to the market. And as Jesse mentioned, hardened hodlers who understand the value prop of Bitcoin have been pulling their Bitcoin off the exchanges. And so the free float of Bitcoin on exchanges is between, I believe, 1 and 2 million right now, maybe 2 and 3 million. And that's not a lot of Bitcoin in the grand scheme of things. And so, yeah, I can definitely see a short squeeze happening sooner than people realize, especially if that trend of draining the exchanges continues in earnest moving forward. And that's like the crazy psychological thing about this is time moves forward. We're approaching 15 years since the white paper launched. Like, people fundamentally understand and grok what Bitcoin is and what it represents and its potential in the future more and more every day. And so they become more convinced in their strategy to hodl Bitcoin. And we've been saying it the last few weeks, like, this is the first time in human history that individuals have been able to front run Wall Street. And that's going to be a fun lesson to watch play out as Wall Street learning, like, oh, maybe we should have gotten in earlier. And they're going to be buying at significantly higher prices.
Gavin, something that Marty just in what we're chatting about here made me think, like, how have you, like, what's your personal kind of perception of the market and just seeing it? Like, we talk a lot about, like, risk adjusted, you know, getting into this space, whether it's buying Bitcoin, building. It feels like we've just been in this, like, you know, roughly 20K for practically 5 years. It hit, you know, top tick 20 at late 17, and we've done a bunch of stuff between then, but you've seen firsthand of people building the space, regulation, infrastructure, liquidity globally. Like, how do you just, like, there's not really a direct question other than, like, how do you see it from a fundamentals perspective and what's happened and what the difference is between from 18 or 17 to 2023 going into 2024 and all the things that Marty just referenced with BlackRock and the, you know, 19 million Bitcoin sitting in people's hands?
Yeah. So, I mean, talking about the United States, first of all, you know, again, I'm just a lawyer. So, but if you think about, you know, one of the reasons why Division of Investment Management was so slow in the SEC to, or got guarded, if you like, on the custody rule updates, was that they realized that they didn't quite know what the bankruptcy remoteness treatment was of, or at least there wasn't certainty in how quickly it would play out as compared to like a broker dealer or a futures commission merchant. There's bankruptcy regimes where, kind of for smoothness, suddenly these masses of customer accounts can get moved over to a different broker. And there's the SEC knows what that treatment is. So part of the reticence is, do we understand bankruptcy remoteness? And then also, is it our job? And I think they kind of recognize that you know, that there are other federal regulators. You know, you look at the OCC and the work that Ryan Brooks did before it kind of got put on hold to charter custodians, basically banks that are custodians, and then some of the work to kind of stop states being able to charter custodians. Like that process, just talking about the United States, is not resolved, and it's taken 6 years. And during that time, you've had, like, entities that were very sort of well regarded, maybe not in the Bitcoiner space, but were large entities, completely come and go. You know, just entities that everyone was doing business with outside of mostly outside of Bitcoiners, and those entities just don't exist anymore. And they look like they were ruling the roost for a while. So I think it's a lesson in realizing that the change takes a while. And I keep coming back to, I hate it. You know, I don't know if Lewis was the first person to come up with the gradually then suddenly expression. Do you know, or does he get that from somewhere?
It's a Hemingway reference, isn't it?
Okay, it's
Yes.
Hemingway. Sorry, we just gave my lack of English.
Hemingway saying,
How he went bankrupt.
yeah, how did you go bankrupt? And a reporter asked him that, and he answered, well, 2 ways: gradually, then suddenly.
Yeah. And so I kind of, we've seen that play out in this space. You know, a BlockFi, a Celsius, they suddenly grew huge. Even an FTX, they grew huge, and then for reasons good and bad, just went away. overnight. And so, again, in a bankruptcy context. So I think that you're within the U.S., you're going to need some more certainty and laws and congressmen probably to come up with some kind of, and the industry, some kind of acceptable regime that gives a bit more certainty to regulating custodians, probably, although that may be unpopular, just so there's certainty. And I think to answer your question, like Michael, like gradually then suddenly, if, there's a reason why spot ETFs have not been approved, just because, and I doubt it's because the difference between futures market surveillance and spot Bitcoin surveillance, the stated reason. It's what are we unleashing if we approve one of these things? And what's going to happen to the price of Bitcoin? And do we want, this is a regulator thinking, do we want, our country's citizens to have exposure to this asset, and that's, in my view, that's sort of what's happening in the reticence to approve a spot Bitcoin ETF.
Yeah. With the pretty valid excuse of, I think it's largely driven by they don't want to unleash this while Binance is still the dominant player who's like flouting U.S. regulators and doing all sorts of potentially illegal things. I think that's a very convenient excuse that they probably have rallied around as a reason to not allow it yet.
And that's why I kind of like the building slowly approach that a lot of people in the Bitcoin space have used. Very, very sort of steps that seem, just seem slow, right, in some ways, but gradual building as opposed to these, companies out of nowhere that come and go within a 3-year cycle. And so I'm sort of bullish long term, but long term might be longer than any of us want. Who knows when the suddenly part happens.
Yeah.
We touched on it last week about private banking, and I made this reference. We didn't go too far into it because it wasn't the topic of the conversation, but I feel like we're in an era of private banking because in my mind, all it means is you can fulfill your obligations.
Free banking.
Or free banking, yeah. What did I say? Private banking?
Yeah.
Yeah, free banking. Free banking, but similar concept, right? Private free, like the idea that there is no Fed to backstop you. And so I think of Binance as just a free banking, like they're fulfilling all the obligations on their liabilities, and BlockFi, Celsius, and all these firms haven't. And the free market is ultimately like delivering on that. And you referenced the evaporating with these firms, and that's the scary part of all of this. Is we've seen companies, whether it's just like traditional tech and free money and what it happens to the quick cycle of somebody's life, like in and out. And then Bitcoin and crypto is even faster. And that's what makes it's like a catch-22 because people can't get into the space because they're afraid all their money's going to evaporate. And then people come into the space and all their money evaporates. And that's what's like so, concerning about these ETFs and being centralized is because they don't know that. All they know is being backstopped and the Fed saying, here's some extra liquidity, and there are no bailouts in this space. And that's part of this conversation. We do it every week. It's like a lot of people are going to get wrecked in this place because this is the first time we're experiencing something of a digital bearer token. And the second it's gone forever. Yeah.
And the funny, like building on that, the funny thing is like up to this point, since the regulators seem not to understand what they should be doing and are moving extremely slow, the onus of regulation has been thrust on the free market and like on us as individuals. Like on TFTC rabbit hole recap, like we were screaming about Prime Trust for years before it inevitably blew up. We were screaming about BlockFi, Celsius, FTX even. And so what we've found, like the best regulation within the space has been self-regulating, where it's creating informational resources and building a brand and the trust with an audience to say, hey, I like to think that I understand this space pretty well and who's doing custody right and who's doing custody wrong. And that has been the extent of, I would argue, the most successful regulation is the self-regulation of educating people about what this is and who they should be doing business with.
And I think that's free banking. Like that's how free banking exists, is like by reputation and where do you take your money and where you don't, because you know that there's there might be a potential mismatch.
Mm-hmm.
one of the provisions we always draft in fund documents is the ability to redeem people in kind. And say there might be situations in when a securities portfolio is just, it's a portfolio that we can't recognize on to over a 3-year period. So we spin off an SPV and then we give it back, so you own the actual assets through the SPV, and then we redeem in kind. And I think one of the beauties of the ability to, in a product where you can actually obtain, potentially the Bitcoin, if you choose to go into an ETF or a fund, and you can actually obtain the Bitcoin. There's some complications there, taxes and custodianship and transfers, and that to me is like a mechanism of honesty, right? Because you have to have the asset available, and that's one of the things we came up with in the Texas law that has come into effect that affects some of the larger trading entities and custodians in digital assets is you have to have the asset available to get it back. And I think the same thing is true that kind of honesty mechanism is ultimately like a good product design.
Yeah. I think that's part of the free banking example here is the winners emerge because they're trustworthy, because they've set things up right in the interests of the clients, and the reputation follows. And with Bitcoin, we have the ability to implement these asymmetric setups that provide asymmetric leverage in terms of fulfilling custody. Specifically, what we're trying to do with on-ramp, but what we've spent a lot of time setting up, multi-institution custody that takes Bitcoin's native multi-sig properties and maximizes security while minimizing counterparty risk, because we have multiple institutions as key holders for the vaults that hold the Bitcoin. And that's not possible in the old world. It's possible in the new world. And in my opinion, it reduces the risk inherent in custody by an order of magnitude or two. And in that free banking scenario, that proves out over time as a better model for doing business, for clients to trust, because it leverages the technology in a way that holds up the interests of the clients at the end of the day.
Yeah, and that's what makes this whole space so interesting, whether it's building, investing in it, or finding your counterparty. Because what Jesse just alluded to, this isn't just tied to on-ramp. I think Unchained Capital is a great example of when we think about free banking on the lending side and being one of the last lenders, BitGo another one, and how they collateralized the loans and also how the keys were segregated and always able to fulfill those obligations. Similarly, with their custody product and holding only one key, they can't lose clients' funds. It's impossible. Now, the client can lose their funds; they have to hold 2 of 3, but it's still a much better model than holding, with a Coinbase or another firm that you're basically trusting unilateral control with. And similar to what we're doing on ramp, the ability to have multiple institutions holding those keys. When you think about it, just makes sense as a better model when you look at this asset. And what's again most exciting is the incumbents inherently will not, most of them, or it's an overgeneralization saying all of them, but I would say 90+%, because we've talked to them. That model is completely antithetical to their whole being, from how they make money to how they think about their industry and coming into this space. Even some of the best firms with the best names, they would never give up control of that asset. And so from just a pure kind of opportunity standpoint of thinking that Bitcoin's going to be here, there's such a white space to create in it, because again, just talking with Gavin and what we're discussing here from a game theoretical, logical perspective, this asset can't centralize with large entities because it's a recipe for disaster. And it just opens up so much opportunity to engineer around it and develop products that just make sense to build that reputation, as Jesse's referencing, where you cannot mess things up singularly. That's not to say that things can't happen, but it makes it a lot harder than what we've seen the past 15 years.
Yeah. The other thing that the new Texas law that came into effect in September, we kind of Texas Blockchain Council and really worked with some of the regulators on, and I helped on a working group for it, was just, to your point, Jesse, just the fact that commingling isn't just something that has to be solved at a books and records level. It needs to be solved at a wallet level. So you can't have, without proper disclosure, at least, you need to have the and specified reasons. You need to have your wallet structure working so that there's no commingling of customer funds with platform assets, except in limited situations. And so the new Texas law has that, and it has maintaining the customer funds in a way you can't maintain them in a way that you can't fully withdraw them. And you also can't use the assets of one customer to secure or guarantee the transactions of another customer. So obviously every law has its scope and application and questions about who it applies to, but that, and then the requirement to have like auditability, accounting standards are kind of still catching up to what works and doesn't work, reserves, and what's its place and what's its function alongside other controls. But it just seems like good accounting standards are critical within the United States that do embrace like the properties of Bitcoin and its auditability, and then its native segregation. So to me, those are critical.
Yeah. So I have a accounting background, and I think it's fascinating how the digital asset space is still sort of catching up to why audits exist. And like, we've gone from a world where there's no accountability in terms of reporting, and then now the big exchanges, the crypto casinos, are pledging proof of reserves as this great innovation, this great breakthrough, that they're going to provide this visibility to the reserves that they have, when really that's 1/3 of an audit. That is proof of the assets on the balance sheet, but not taking into account liabilities or how the equity plays out there, which is comical to me from my accounting background, because the whole picture matters. The whole health of the business, the whole health of the balance sheet, and the other financial statements. You have to see that all together in order to feel confident that this is a going concern business, and they are sound. So in the example of like Binance, they have implemented proof of reserves. Great, you've got assets, but do those assets come from liabilities? Like are some of those borrowed assets that you owe to somebody? We don't know, because that hasn't been a part of what customers demand from the businesses they work with in the digital asset space yet. And regulation is still sort of like catching up to that as well, in terms of what is required of which digital asset businesses. It's all just kind of funny that like there's 150 years of learned wisdom about how to keep track of who's a healthy business and not in the accounting and audit space in particular. And we still haven't fully embraced that, but it's coming slowly.
Yeah. And those accounting standards probably take 2-3 years to get created.
Exactly, and we're seeing that right now with the updated FASB guidance, which I was just digging into this weekend. My latest writing was on that. MicroStrategy and Michael Saylor have been advocating for this for 3 years, ever since they got into, they went on a Bitcoin standard. Historically, Bitcoin is expected to be accounted for as an intangible asset, which means that when the price of it goes down, you have to mark down the value of your assets and record that as an impairment loss on your earnings statement, which kills your profits whenever the price of Bitcoin drops. But you're not allowed to record the corresponding rise in price as a gain. So MicroStrategy is carrying a $2 billion loss on, cumulative over the last 3 years on their earnings statements and balance sheet. And they've been petitioning the whole time for FASB to update the guidance to do fair value accounting, which they have now unanimously said can happen starting January 1st, 2024. And that's going to be a big step forward for accounting of Bitcoin, and MicroStrategy is going to be the big winner in that.
Gavin, on the one of the things, like personally, and I think the audience would be helpful, is on the UCC ruling of the intangible assets and where it started with Wyoming, and I think Texas being, I think, probably second in really the adoption of it. Can you share any of like the recognition of Bitcoin as property and how that was big for Wyoming, and where Texas like has adopted that standard and what that means? And I guess a little bit of like the background I was listening to, it was one of the guys I was familiar with this, I think in Wyoming, and he basically went as far as saying that you shouldn't operate in a state, this was his words, you shouldn't operate in a state that does not recognize the UCC ruling as Bitcoin as property. And I didn't fully, I mean, I kind of directionally understood it, but I'd be curious if you can kind of like help us understand that to the extent, and I don't know if I'm putting you on the spot here, but if to the extent of
Yeah, so I'm not a UCC expert, but one of the things that the custodians did when they wanted to obtain certainty under the law is they said, I'm going to put, or asset managers, I'm going to put the asset with a third party, and I'm going to treat it under the UCC Article 8 as like a securities intermediary, because I know what happens when you're securing an interest in Bitcoin at that point, a security interest. And then I kind of got around all of the uncertainties of Article 9. And so really Wyoming was, way out there with Caitlin Long, and sort of saying, well, what is recognizing Bitcoin as property? Obviously you can understand why a state like Wyoming would be very in favor of property rights. But also just having certainty in that very boring mechanism that we are subject to every day, where, we get a car and it says there's a secured interest on the car if there's, a loan. All basic principles of finance. You need the certainty. So Wyoming went out there, and Caitlin Long and others went to basically war with the Uniform Law Commission and the other entity that UCC is like private law. It's like, let's all decide how we're going to treat this, and we'll come up with the standard. The Uniform Law Commission is not a government entity, and then states can adopt it. And so it's a unique process where you say, okay, does the state want to adopt this essentially a private law concept, and say, how do I get a proper secured interest in Bitcoin, and do I recognize it as property? And so the Wyoming came up with a law, and basically Caitlin and others went to kind of war with the Uniform Law Commission about how they were thinking about things. And eventually there was a big swing internally in the Uniform Law Commission and the other entity that kind of helps create standards in this private law. And so they came up with a definition of something called a controllable electronic record that basically says, how do I get control over the asset? Do I go file a UCC statement? What do I do? And so they came up with a test that basically says you have to have the power to prevent someone else from using the asset, and you have to have the ability to avail yourself of substantially all the benefits of the asset. And there's a third requirement that is escaping me right now. But there's these requirements that actually fit the way that multi-signature works and digital asset works, and recognizes that, like Marty says, it's, to some extent, it's like a bearer asset. So the definitions are kind of hard to understand, and they create confusion, but it's just a critical mechanic if you're going to be holding Bitcoin, for instance, and you want to get dollars. You don't want to sell your Bitcoin. You want to get dollars for everyday expenses or whatever. And for those transactions to happen, you need this certainty. So you see, Wyoming led the way. The sort of people who understood digital assets found their way into those private committees, and then, I forget the number, if it's 20 some states are sort of behind those laws. And then, so I hope that answers your question.
Yeah, I think that ties into some of the Texas stuff, but I'll let Marty go. But yeah, I think just the recognition, like you referenced with the proof of reserves, and knowing that kind of like backstory of like Wyoming leading the way, and then Texas, starting to adopt some of it and taking further steps with the proof of reserves was helpful.
Well, yeah, I wanted to really extend this conversation of how states are going to look at this and try to project forward. Like, Gavin, in your opinion, like, how do you see this playing out in the future? I mean, just to give some context, when the federal government came out and was sort of postured like, hey, we're going to tell the banks not to bank crypto and Bitcoin companies. You had Ron DeSantis stand up in Florida and say, hey, our state charter banks are open for business. If you're a company in the Bitcoin space that needs a bank account and you're within our state, you can use the state charter banks. And it seems like even outside of Bitcoin, that sort of posturing of individual states and their charter banks versus the Federal Reserve System is going to heat up, whether it be about the ability to give loans to fossil fuel companies or people beginning to have their transactions censored for doing things that the federal government doesn't like, and states saying, hey, we think you should be able to do that, so you can do that within our banking system. Like, moving forward, do you see this trend accelerating and the sort of juxtaposition of individual states and what they allow the banking sector within their states to do business versus the federal government?
So you have, like in Texas, for instance, the Department of Banking came out with guidance that you can custody a bank, a state chartered bank can custody Bitcoin. But has that really happened at large scale? Not so much. And part of the reason is that the banking system in the United States is so complicated as to what the state regulator does versus the federal regulators, and the fact there's more than one federal regulator. So what the Federal Reserve does, and whether or not you can give a state chartered entity a master account to be able to settle more frequently, that sort of thing, there's still a massive dependence on the various banking federal regulators, and they are under the current administration not open in the same way that they perhaps were when Brian Brooks was at the OCC, to embracing banks holding digital assets. And it's in part just because they don't understand it, the risks, et cetera, and whether any public blockchain is consistent with safety and soundness principles in banking. That's not something that the federal regulators have even conceded. So you could see some push to private blockchains because they find that it fits into their safety and soundness rules better than they understand with public blockchains. So you're going to see some major resistance without a change in administration, in my view, to, at least at the federal level, the banking regulators really allowing the industry to move forward in a way that, now even some of the biggest institutions want it to.
Yeah, Jamie Dimon coin, Marty. Is that's the new thing?
JDC is the new BTC. You heard it here first.
Gavin, the thing you referenced with the state banks and banks in general seems very similar to like the SEC and the ETF, because I know there's other regulations on the federal level with like custody and the one-to-one, I believe, parity with dollars to like Bitcoin being held, and it just feels like a kneecapping of the whole setup. I think what you reference is what Caitlin in Wyoming have run into with the Custodia and basically getting access to the Fed window while they can operate at the state level. And that's where they're in their lawsuit. So it sounds like until there's clarity there, maybe it's the ETF and then everything's all lights green. It will be in that kind of like wait and see mode from these larger entities on how they're going to get exposure or allow for exposure from their clients.
Yeah, and there was albeit skeptical, but there was and I forget the name of the venture capitalist, but a famous venture capitalist gave some kind of equivalent of a TED talk recently about regulatory capture.
Yeah, Bill
And
Gurley.
so he gave the example of like, the fact if Elizabeth Warren goes after digital assets, for instance, suddenly her list of top 10 donors include the largest digital asset companies. And that's just that you have to understand these dynamics to understand how change is or is not going to happen. Actively attacking an industry like writing to Texas about mining and Bitcoin mining, et cetera, has an effect of attracting donors, which has an effect of increasing and this is my personal opinion, not of the law firm, increasing the sort of power of in DC of the right people, and so you're not going to make change at the speed that you expect if there are people that are making sure that their domain remains large and well funded.
Yeah. However, this was sort of the key insight of Sam Bankman-Fried in pushing for the kind of change that he thought was a good idea. But I think your point is absolutely right that like as Bitcoin succeeds and Bitcoin companies and Bitcoiners become a more prominent part of the capital base and industry, that ability to exert influence grows in DC, and that is a tailwind for better policy over time as Bitcoin's mechanics play out, and hopefully it becomes a bigger part of the asset landscape.
Can we do the Bill Gurley route where he said, I was trying to get as far away from DC, and let's say let's forget about DC. Let's focus on Texas, right?
And that's what, we have. We have a law in Texas now that addresses commingling and making sure funds are actually available in a way that Bitcoin actually works. So that's exciting to me. And that's a great strength of being here.
Yeah. And I mean, on the Texas thing, it's not a accident. We're all based in Texas, soon to be. One other individual on this call. But like Gavin, like, you talked about politics and like how it works, and it's been public. Lee was recently on with Nick Carter talking about Winstead and TBC and some of that, like to the extent you can share some of those dynamics, like why you think, Texas, Wyoming's also part of it. And there's like this natural kind of inclination for, freedom and sovereignty, but like how that ties into also some of the work that's being done, on the political side, the mining, like just if you could share any of that dynamic, because I'm personally, as a native Texan, very interested and just excited that like have led this way. It feels like it's not going anywhere. We have the bullion depository up in North Austin that sits there, and I think it's the only state sovereign bullion depository. So we're heading in this right direction, and so we think about building a business, like it makes sense to be here. But you're at the forefront of it, sitting in there. I'd be curious to kind of hear like what's going on and how you think we got here and where we're going. Yeah.
So when some of the early events that I attended, obviously, were like that consensus event was pretty big. That back in 2018, 2019, and I remember seeing Gideon Powell, who is does a lot of work in Bitcoin mining in Texas, stand on the stage in New York with 8,000 people and just said, look, Bitcoin's coming to Texas, and talk about it. And it seemed like a really typically brash and bold and kind of wonderful moment. And then, that was all before all of the changes with China and a lot more Bitcoin mining coming to Texas and creating an environment that supports mining, where there's this kind of exchange with the energy grid to try and stabilize the grid, and this unique ability of miners to switch off at peak demand times. That's a whole nother unique part of Texas, and I think that I'm still on my calls with the Wall Street Blockchain Alliance in New York, New York, DC lawyers for the legal working group, so I can keep up to speed and we can exchange ideas on kind of legal issues. And there's been several weeks when they've just said, look, Texas, it's all about Texas this week. Like, what's going on in Texas? Because there's so much activity around mining that obviously Marty and y'all can speak to really well, but that's also fantastically, uniquely Texas.
Yeah, and I think just bringing the mining aspect into this really adds like a layer of complexity for regulators, right? Because you have this digital bearer asset that many people view as money, some people view as property, and accrues in value. And then you have this connection to the physical world, which manifests via the mining industry, which is very energy intensive, and figuring out how to separate the bearer instrument from the mining activity, and like how do you tackle this behemoth that has been thrust on the world is, again, something that I think slows down the process on the regulatory side, and I think really points to why you're seeing states leading the way, particularly here in Texas, because Texas understands energy. Obviously, we have ERCOT, which is very unique within the United States, and it's becoming abundantly clear that Bitcoin mining is an additive, positive value add to the grid system, and that's why they're moving first. And we're seeing this begin to happen in other areas like Tennessee and Appalachia, where the TVA is beginning to realize that Bitcoin miners are helping out there. But yeah, and that's been my theory for a while, is that states are going to lead the way, particularly in the mining industry, the energy-rich states that really understand intuitively how the energy sector works and how you pull molecules out of the ground and turn them into electricity that allows you to turn your lights on. They're going to understand this quicker. And that's actually pulling this into the broader conversation we've been having for the last hour and a half almost, is that it gives me a lot of comfort knowing that these states are leading the way here. And hopefully they can create the precedent that the federal government can say, all right, maybe you guys got this figured out. We won't get too involved with it.
Yeah, and there's real money and recognition. We're long overdue we got to get Gideon and our friend Griffin Habe. Maybe we could do a double on the mining side here in Texas. If we talk a lot about meetups in Bitcoin and getting together, I think Houston meetup probably is one of the most special and different, because when the market in the I don't even know if this is politically correct, but our friend Griffin Habe will say Chexit happened. As the miners were leaving China and heading to Texas, Houston, that between Houston and Midland, and the amount of native Texans that recognize, there's no such thing as stranded energy, and just fully embracing it, not even fully understanding that, like, I need to hold this long term. It's what I can transition physical oil and gas into this thing that I can get dollars for. The second they heard that, I was like, game on. And I've never seen it happen that quickly. And then that translates to politics and all of it, because of the majors show up to these meetups. They're still there. We know that they're looking at multi-sig, they're looking at mining and all the things. And so that entrenchment, to Marty's point, just sets the foundation for this not to leave, and then to be ripe for kind of innovation and continue to grow independent of anything at a federal level, because now you're messing with actual individuals that are paying taxes to the state.
Yeah.
And Marty, I don't think it had ever really hit me before you just mentioned. Yeah, most people probably don't even know that there are 3 grids in the country, in the continental U.S. There's the West, the East, and Texas, and that's it. And because of that, because Texas has its own grid and has to balance and deal with grid stabilization issues on its own, that becomes a more pressing issue for Texas specifically to solve. And so Bitcoin mining becomes a solution that makes sense quicker, right? And is more quickly embraced as part of how that problem is solved. And so I never really put 2 and 2 together before that, beyond the, seasonality and energy mix that Texas has and the history that Texas has with energy, there's this pressing need to solve the decentralization that Texas has with its energy grid. And here comes this decentralized energy solution that can be a part of that. It's so interesting.
Yeah. Yeah. And I also I just love going to see like a facility that like, Gideon built or someone else built, and actually see how it works. And I still don't know much about the stranded gas and how, that gets turned into the electricity that feeds the units that are right there. But
I still think that the most badass video of Bitcoin mining I've ever seen was posted by Marty, and it's a shipping container in the snow at night with these machines whirring away, and then the camera pans outside to a flare right there on the oil field, and this is how it happens. It's this translation of that stranded energy in this remote and hostile environment into energy in a digitally connected world. It's wild.
Yeah. Now you guys got me getting all nostalgic about Great American Mining, but no, it's beautiful too when you see like particularly upstream on an oil and gas well pad, like the instant visual satisfaction of turning on. So Gavin, you asked like how do you actually produce the electricity? It's just generators. You bring them on and you pipe the gas that would have been going to a flare stack to the generator. Maybe if it's a bit dirtier, you got to scrub it up first before you throw it through the generator. But in simple terms, you're just diverting that gas from a flare stack to a generator, producing electricity, then mining with it on the back end. And so you have that direct efficiency gain with the reduction of flare and actually getting value out of that gas that you were just literally setting on fire moments ago. And then to your point, like how do you produce the electricity? That's another thing that I'm very confident about, is that Bitcoin mining is going to create the incentives to have better generators at the end of the day, because uptime is of the utmost importance. So when you talk about like the positive externalities that emanate from Bitcoin mining, whether it be behind the meter to do some load balancing for the grid or upstream to do flare reduction, it's going to create these crazy efficiencies in many different areas. And that's just on the mining side. We're not even talking about the digital asset that creates capital efficiencies, that creates efficiencies in terms of sending money globally. Like the fractal nature of how Bitcoin improves systems in the physical world and the digital is pretty insane when you sit down and really begin to understand what's happening.
And then it's global. Like we know Latin America, Middle East right now, but to Jesse's point about the GAM video, I think of when you reference that, I think of the China stuff. Like there was a two that ring out where it's like a village in the middle of nowhere with the water using it into like this weird, like
in the jungle,
small generator. Yeah. In the jungle. And that's like making more money than they probably would make it in that local economy. And then the other one was just like, when we think about anybody ever banning or all the stuff with Bitcoin, it's like, it's China and they still have whatever percentage of the hash rate. And then they had these like modular setups where they have like spotters to look when people are coming. And then they just like literally close the gate on the, the truck or however it's set up. And then you just take off and you go to the next location. It's like, there is no stopping any of this. It's just, you either embrace it or you don't.
Yeah. And you guys got me excited about, what like gridless compute is doing in Africa, of implementing infrastructure in places where they haven't had a grid because there hasn't been an economically viable business case for installing energy production. But now there's Bitcoin mining. And so you've got all this hydropower in parts of Africa that you can set up a micro hydropower energy producing unit. And for now, the bulk of that energy is going to Bitcoin mining. But now there's energy in that location. And so if industry wants to set up there and say, well, we'll pay you a little bit more for that energy that you're now producing, they can. And then you're bootstrapping industry and economies in a place that hasn't had that catalyst before. It's beautiful.
Yeah. And I think one of the, and this is where like the boring stuff, working to regulators is important, because
full circle here.
Texas Texas just came up with a tax incentive for using flared gas for on-site Bitcoin mining, and so there's not reducing taxes. So that sort of stuff is important to make it happen.
It's essential. That adds a massive tailwind to what is a good economic force, and it should be how states, especially we talked about how Texas has this particular need to incentivize this solution for grid stabilization, and that's how you do it. And states can lead the way in incentivizing these things that are good for their energy system and the whole economy of the state. And Texas is leading the way because it has the greatest need for it.
Yeah, it just reminded me of like Gavin and Jesse and I, like building this business. You come across different individuals, and I reference McClintock in that same spectrum on the legal side, where it's always fascinating to have like an expert, but then an expert that's curious, because that's when you like mirror what their personal interests and then the curious, and then they find it, and you find like just world-class operators or individuals. And thinking about Winstead and what you just referenced, like is there even would you like top 5, you guys have to be there in like legal firms in the world that understand this space, partially because we're still so early, but that's not, it's also indicative of like what you guys are doing. But then 2 is like, how much does that have to even do with being in Texas? Like, could you have been able to operate or have this like free ranging thought or taking on the clients that you do if you were based in, I don't know, California?
Well, I do love the fact we're like 300 lawyers at Winstead, and so it's not like we have 10, 15, 20 people sitting around doing only digital assets. How we do have a lot of people working on energy, and a lot of people working on real estate, a lot of people working on construction, and all of that is the stuff of Bitcoin miners. And so I like that. I think we're, that places us well. And then probably, there's plenty of, crypto law firm practices that are, more focused on Web3 and things like that in other parts of the country, in Silicon Valley, and then in New York and DC. So I do like the kind of unique Bitcoin mining and Bitcoin centric practices. Obviously projects come in the door that are other things when you have 300 lawyers. However, it's always essentially been, Bitcoin and Bitcoin mining that keeps me busy outside of straight investment fund launches.
Yeah, Bitcoin seems already hard enough from a regulatory and legal perspective to manage. I can't imagine having 1,000 cryptocurrencies, and how do you think about custody and securities and what's a token and all the other stuff.
Right, exactly.
I mean, that gets to an interesting point I'll just touch on briefly, but I think that's another thing people don't understand, that Bitcoin's native multi-sig properties are sort of unique to Bitcoin. Like, you can't do that with Ethereum and many other the popular cryptocurrencies. Which I imagine sort of muddies the water when you're trying to create regulation around this, because even within quote unquote crypto, Bitcoin is very different from a primitives perspective to the other protocols.
That's actually a really great point, Marty. That's where I think like you end up seeing qualified custody and arrangements or opinion letters around, multi-sig and some of the stuff we're doing in multi-institution probably quicker than we would initially expect, because it's it's applicable to any custody arrangement, any exchange, any new business that would do it, versus what we talk about here of like, if you're building, a crypto exchange or custody arrangements around it, it's all pretty proprietary to the infrastructure provider or the third party you're opting into. And so it's a lot harder to like create the right framework so you can actually get that legal qualified custody wrapper around the actual underlying technological, physical custody.
Yeah.
It's probably also, it's the regulators understanding, the nuances of even what Bitcoin is versus other digital assets like that. That's still not easy to achieve, because they have their own interests and their own people giving donations and their own, so that's complex. And then, the work that y'all are doing to help everyone understand. So, yeah, I don't know. I just think that sometimes in the regulation, to make things happen, you have to sometimes, have strength in numbers. So I think there's times when you need to, your interests are aligned, and times when they're not. So.
And we want to be respectful of your time. I know we've gone a bit over, and you are an extremely busy lawyer. So you probably need to get back to your job. But before we wrap up, I guess just to tie things together, moving forward, what should our audience expect from the regulatory perspective, from your opinion? Like, is this going to continue to move as slowly as it has? Do you think the regulators are going to overstep? Do you think we have some time to really educate them? How should people be approaching the particular problems that exist from a regulatory and compliance perspective?
Yeah, so you have to be realistic about making sure your business model works with the current laws in order to have success. And sometimes that might mean being more focused in what you're doing and staying that way for a while. So that's probably the biggest lesson, because, it changed the whole gradually. Then suddenly 6 years talking about the custody rule, and we're still at a proposed rule stage. That change happens, it happens slowly, and there's a lot of interests in DC to make sure that, frankly, coins that could be censorable are a little bit more attractive to federal regulators in some ways. But understanding the security risks of that and the implications and Bitcoin's unique properties, in my personal opinion, are absolutely critical. I just think that don't expect the custody rule to come into effect tomorrow. Don't expect that the regulation, that federal regulation, it will come. It's just a question of when, that actually solves who's looking after and actively regulating spot Bitcoin custody and spot Bitcoin trading. That will change, but I think we've seen it takes a long time, and there's going to be a lot of businesses that go full cycle in that time if they don't build slowly and well.
Sage advice. Focus. Focus is good. Move slow. Do things the right way. In the meantime, us in the industry will be self-regulating and calling people scammers and trying to herd people towards the good actors in the space, which are hard to find. There's a lot of noise out there. Michael, Jesse, anything to wrap up with?
I just want to thank Gavin for being gracious with his time and coming on. There's a lot of information. This is an awesome show, I think, to look back on, or as an evergreen, to just talk about where we're at, where we came from, where we're at, and then potentially where we're heading. So appreciate it, Gavin.
Thank you.
Yeah,
Great.
There's a lot of Bitcoin podcasts, but very few of them have on like lawyers who know what they're talking about. And can really dig into the law. So for the listeners who made it this far, I hope you guys enjoyed the rolling up the sleeves of a seasoned Bitcoin lawyer here to really show us the ropes.
Thank you, guys.
Well, thank you, Gavin. That's all we got this week. We'll be back next week.